Ladies and gentlemen, my name is Greg Michalowski from ForexLive.com, and as you can see, I'm wearing a different uniform here today. No jacket, no button-down shirt or solid colored shirt. I've got a Hawaiian shirt on here, and that's for a purpose. Why? Because sometimes in trading, you need to take a break. You need to go to the pool, go to the beach. Why? Because risk may be too high. What do I mean by that? Well, let's get into it. Risk is, there are three types of risk that I look at when trading. One is market risk. Market risk is with us each and every second that the market is open. You can hedge market risk or protect from market price risk by utilizing technical tools that define your risk and limit your risk, and you're able to understand that, well, I can lean against certain technical levels and I can risk a little to make more than a little. So that's market risk. The second type of risk is event risk. And event risk occurs a lot of times at scheduled times. We might have the employment statistics, we might have housing starts, we might have inventory data. These are events that are scheduled, and we as traders are able to at least understand when those events are going to come out. We know the expectations of those events. We know the importance of those events, and we can make judgments as far as what the expected price movement might be and whether we want to be in the market or we don't want to be in the market as a result of that event risk. Those are scheduled events. There are other types of events that aren't scheduled, non-scheduled events. This might be a headline from a Federal Reserve official or a central bank official that's really not scheduled, that comes out. It might be an article in a newspaper, an article in a magazine that really the market didn't know about, and it comes out and starts to move the market. Or it may be something like a Brexit poll. In the UK right now, we are 10 days away from the Brexit vote. That's going to determine whether the UK stays in the EU or leaves the EU. And so these polls that are coming out now are having an impact on the pound versus US dollar in particular, and that impact can be very volatile. 160 pip move, 200 pip move in the matter of minutes, and that can be very detrimental to your health. Hence, you may want to go to the beach instead and save your money. Those events are unscheduled. Why? The polls can be released at any second of any day. On Friday, we saw a poll come out that was more in favor of the leave, and it was after the European and London traders had gone home. So liquidity conditions were very sparse, and we saw the pound sterling move sharply to the downside through here. You see that move to the downside. That was off of that poll that came out after when liquidity conditions were very, very low and traders weren't around. And so these polls can come out at any time, and that's what happened in trading here today. We had a poll that was more bullish here to the upside here for the pound versus US dollar, and we saw the market, or actually not a poll, it was a rumor of a poll that saw the market move sharply to the upside here. That was about 160 pips to the upside, ran into the 38.2% retracement, and then started to reverse itself. Why? Because it was just a rumor. And then we started to get we actually got the actual poll come out on the headlines. And what did the actual poll say? It said that the remain was ahead of the leave in the Brexit poll, and that's more bullish for the pound. And so we saw the pound move sharply to the upside in this case, about we'll figure it out myself, right here to here, about 129 pips to the upside in a matter of minutes. And what did we find out subsequently? That the headline was wrong, that it wasn't that they were going to remain, but it was going to they're going to leave, so it's fast break the other way. So the rumor was wrong, the actual number was wrong, and then we had the real number, and now we see the market settling down because traders went to the beach, they went to the pool, they started to give up on trading the pound versus US dollar because of this uncertainty, because of this event risk, which is you can't trust. You can't trust. And we need what? Trust in our trading. All right, remember that webinar from last week. So that's the second type of risk that we have is event risk, and event risk, again, can be unscheduled event risk, and that's the worst type of risk. It increases the event risk. The third type of risk is liquidity risk, and liquidity risk occurs when traders when event risk increases, right? And so what happens? The broker spreads go wider, the price moves sharply, and market action gets very choppy. And these are types of risks that we as traders have to face because of the liquidity conditions in the market. And that's not a good thing either. When liquidity risk is high, when event risk is high, when market risk is high, it says what? Go to the beach, go to the pool, get away from the market, at least get away from that currency pair. That brings me to the second point. Now, if you have to trade, if you really want to trade, if you are addicted to trading, whatever, you may not want to trade the pound sterling, but maybe you can go and trade the euro versus US dollar. And this pair is not without risk. The euro sterling is going to move around, so it's going to be, it's going to affect the euro as well. But the volatility in the market should be less, and perhaps you can find some extremes levels, some levels that you might have interest in selling or buying or trading against, because risk can be defined and risk can be limited against those levels. And you're not going to have the 150, 200 pip moves that we're seeing in the pound sterling. So if we take a look at this euro versus US dollar chart, it's a 4-hour chart. And we saw earlier on in trading, we saw the market find support against what? This blue line. This blue line represents the 100 bar moving average on the 4-hour chart. This 4-hour chart. So we found support buyers against that. Traders were leaning against the 100 bar moving average on the 4-hour chart. Why? Because risk can be defined, risk can be limited against that level. Why not? If I can risk a little and make more than a little, that's okay. And so lo and behold, the market ended up moving to the upside. And that upside move came right up to the green line in this chart. And this green line represents the 200 bar moving average on the 4-hour chart. Now, I would be lying to you if I didn't tell you that move to the upside here was helped along by what is happening in the pound sterling. This is this move to the upside through here. In fact, when the day started in the euro versus US dollar, in the New York session at least, the market started to move to the downside. And again, we got close to that 200 bar moving or 100 bar moving average on the 4-hour chart. This distance only was the distance between it, and then we started to move higher. But even on the move on this move to the downside, if you thought the market was going down, and I thought it was in earlier trading today, you still have to be cognizant of your risk, okay? And so if the market moves above the 38.2 to 50% retracement, or if it moves above the 200 or the 100 bar moving average, then all bets are off to the downside. And indeed, when the market moved above the 50% retracement and then came back down toward it, we found support buyers. And the next time the market moved above the 100 bar moving average, it was all the way to the upside here. And so traders reverse their position, and you have to do that too. You have to be cognizant of the risk you're taking, and also understand that that might have an impact from the pound sterling, may have an impact on your trading as well. But since that time, we have seen that the 200 bar moving average found sellers, early sellers against that level. And so now we have support against the 100 bar moving average down below and the 200 bar moving average above on the 4-hour chart. And that's going to define our ranges and keep us, allow us to limit our risk against extremes and maybe get a trade in here and there in the market. The other thing I want to tell you about these types of markets, when liquidity conditions are low, when the market has huge event risk and such, is if you get on a winning trade, take profit, okay? Don't look to ride this, to attack this currency trend for a long period of time. Understand that any news event can cause any unscheduled news event can cause the market to reverse itself fairly quickly and go the other way. So if you get lucky by leaning against a level on either to the upside or downside, and the market moves your direction, find areas where you can target, where you would look to take profit, where you think the market would look to go the other way as well. Also, if the market should break outside of the ranges, if we're utilizing this this 100 bar moving average and the 200 bar moving average on the top side and the bottom side, if the market should break to the other direction, get out. Don't mess around with it. You're just looking for a trade to kind of keep you into the market, keep you satisfied. But you got to understand that the risks are still increased all along the curve of currency pairs because of what's happening in the UK. I hope you like this video. Also, let me remind everybody that the ACT trading course is available. Enrollment is open for those traders interested in. Click on the link below, and that will give you all the information and send you to the website where you can sign up. So I look forward to that coming up in a couple weeks, and hope that you can join us in that course. My name is Greg Michalowski. Good fortune with your trading, or enjoy the beach. Bye-bye now.